Hi, good afternoon, everybody. We'll just wait for a couple of more minutes for more participants to join. We'll start in about 5 minutes. Hey, thanks everyone for joining in. I'm having some issue with my camera, so I won't be able to turn that on, but I'll make sure to keep it extremely interesting. So today's topic is war and markets. We'll just go through how multiple situations arise, multiple situations have come to us, and what usually happens to markets and how you need to position yourself in every case. Okay, it's going to be slightly long, but I will run through it so that we can have some amount of time for Q&A. Okay. Okay, you've seen this Israel-Iran war, India-Pakistan war, multiple news coming in, multiple events taking place, multiple support coming in. So you can visibly see sides forming and who's siding who, what's the sort of support that's coming in for each of these countries. Okay, but it is a scenario, and it's not different. because you've had multiple scenarios uh, in, of war where markets are thriving continuously. Of course, there will be one part that fuels that war. So, and there's one part that is going to grow. So, we are in this situation and expect that these situations keep arising because of the wealth disparity that's there, because of how trade wars are forming to be. So expect that these scenarios are normal. Okay. Now, what happens to markets? Now, there is always a reason to sell. Now, the latest one was the India-Pakistan, then the Israel-Iran war. So, but over years, if you see, you always had a reason to sell, and markets always tend to bounce back. So, what do we need to see now from here on? We only need to see, okay, when situations arise like this, what happens? How long does it take for revivals to take place? Are they as bad as what uh, news channels and TV anchors claim it to be? Like, how deep is the problem? Is there a deep problem at all? So all these questions are what you should look out for in a scenario of war. Only then take a practical decision on how to move forward. Right? But if you look at it from history, we've always had a reason to sell equities. Right? 18 and 19 had a lot to look at the 18 and 19, and then 20 came in. 14, 15, 16, 17, again, very, very big. So you see a lot of events take place, but the market always tends to bounce back. How bad and how big is that particular bounce back? So if you see crisis over crisis, you at the worst crisis, right, at the worst of the scenarios, you have a 30-35% on average fall that takes place for the at the index level, right? If you see long-term growth from 40 years or so is about 13.5%. But if you see period by period, you see there are periods where you see extreme peakness coming in, extreme optimism coming in, and that bubble sort of bursting. Then crisis comes up immediately after that. So you see global financial crisis, you had 60%, everything wiped out. You had a European debt crisis, 30%. You had the China economic slowdown about 25 odd percent. Then Corona about 40. These are all peak events that can take place, right? These are all plus one, plus two standard deviation sort of events where it's not likely that these would keep on coming over and over again, but something or the other definitely shows up, and you have to read through the gaps for you to know whether these are issues that can come up. But recency bias is always very high during such cases where everybody starts thinking that no, that situation can come up again. You might see that big of a drop. No, liquidity always fuels that amount of growth that comes in. So be aware that these scenarios do not come extremely often, but they do arise. Not very often. You can see, at best, the worst of the cases, 25-30% is a good drop to sort of look at. It can either be prolonged or it can be in one shot. And usually, it takes about a year and a half for the entire thing to play out if it's prolonged. Okay. Now, uh, if you look at this, upsides are a lot more higher than the declines. So if you see from a decline perspective, these are opportunities to heavily participate in, no matter what that opportunity might look like, right? Even in the worst of the periods between 86 and 90, between 88 86, you see that when you have such scenarios coming in, you should look to take advantage of, right? So whenever we've seen this advantage being taken, today you see Nifty at a very good level from all this war type scenario that was there for us between India and Pakistan. But more or less, these are cases to take advantage of drastically. So what happens during a conflict? Now, these are all good sources, right? Historically, markets have dropped to varying degrees during such event, but have rebounded on all occasions. Now we only need to see how have they rebounded, right? Now, if you look at particularly for India, okay. Now, if you look at the impact of the past conflicts that we had on our macroeconomic variables, right? You see that fiscal deficit sort of shoots up. This is 62, 65 centimeters. These are old history, right? But you see that fiscal deficit starts shooting up, inflation starts shooting up, and growth wavers. It can go up, it sort of can go down, but the impact depends on that particular scenario. right? But you do see that it going up. In today's case, right, what has happened? Inflation has normalized. Your fiscal deficits are very well controlled. It's not extremely high, and growth is moderating not because of the war, but naturally because of geopolitical tensions outside that are there. So internally, we do not have much issue that's there for India. That, but outside there are a lot of issues. So this raises a question to say, okay, that means, when we are coupled or when we are decoupled from the globe, do we have a very big impact or not? Right? During the all of these are small proofs, right? During the Kargil war, we saw that yes, there was a good drop that came in, but after that, recoveries have been extremely large. Short-term impact, if you notice, every time, some sort of border action has to happen from our side, you see that the impact has been becoming much lower. Right? Look at 16, look at 9. You're seeing a lot of lower and lower impacts that are coming in. Even during this phase, we did not have a drastic impact that came in, particularly from a India front. But from a geopolitical tension, definitely there were huge impacts that came in. So you see 1 month before you, 1 month after, if you see, there's in some cases there's slight recovery that takes place. 3 months after, 6 months after, and 12 months after, there's definite big recovery that can take place. Right, there, barring one particular condition in which we had a parliament attack. But more or less, in a year, and this time we've had the recovery to be much faster, which is again within the 3 months. So you do see that we this attack sort of comes in the 3 month category. Okay, so with every attack or with every scenario that comes in, which is more and more looking like a war-like scenario, the bounce backs have been faster and the drawdowns have become much lower inherently because of India's strength, right? In terms of your macroeconomic fundamentals. So more or less, we are very well covered. Now, this is a very important slide. Why? Because that question that we raised, whether are we going to see that level of impact because of global issues that can come up. Now, if you see, India is not decoupled, but since 1980s, India has largely avoided full-blown recession. Although we have seen slower growth coming in during periods of global recessions, right? But more or less, we have been able to come over it. Now, I'll pause here and I'll open the floor just to for some good dialogue to take place between us. That do you think that we are in a recessionary environment, India and the globe? Do you think that we are in a recessionary environment? Okay, in general, no, but some sectors like auto are struggling. Okay, I take your comment. In general, I think yes, more or less, we are having a slowdown across the world, in across countries as well, because economic conditions are not very conducive for growth. So India also is seeing some amount of growth that's getting slowed down. Second, in terms of auto, particularly let's say consumption sectors. So you have the eighth pay commission that is coming up in August, and all data has always shown that after a couple of months of implementation of the pay commission, you have that it takes about 12 to 18 months for the whole thing to come under effect. But what happens is that your consumption starts doing extremely well, your staples, your discretionary or auto. So there is good signs that with the tax benefit in India plus eighth pay commission plus inflation coming under control, and interest rates going down, you might see that score of consumption in India to bounce back very strongly. So across the world, you do see this issue that yes, there is a deep slowdown that is a problem for them given their economic conditions. But for India, we are more or less resilient towards global recession. So there is a slowdown, but more or less we are very well covered. Right? That is where India stands now. In terms of valuations for India, given this risk that is there globally, we are trading at a fair to neutral sort of valuation. It's not cheap and it's not very expensive as well, but not cheap. Right? So in this sort of an approach, what is the strategy that an investor should actually implement? Right? Now, when we see another highlight of whether are we trading at a premium, are we not trading at a premium, given the growth rates that are there, right? Growth rates for earnings have moderated little bit, and given that we still trade at a premium over the last 5 years, we are more or less fair, right? But towards the tenure, we do trade at a slight premium. So we have to be very, very picky in terms of the headline indices and what are the stocks and the sectors that we would like to invest in. If you look at mid and smalls, completely out of valuation range, that is not something that we would like to put a lot of money in, particularly for Neo. So how does Neo actually fit for investors? When we look at the current condition that's there. So what does an investor need to do? Neo is a strategy that employs a multi-asset strategy, which means that there is no cap on any particular asset class, which means that we can go 0 to 100 in equity, 0 to 100 in debt, 0 to 100 in precious metals. Okay, it's a mix of top down and bottom up research on all asset classes. For equity, we use a top down plus a bottom up. Going forward, we will be able to see that as well. Plus, for precious metals and debt, definitely we use a more top down approach. Right. The strategy that we employ is more concentrated across certain themes, like your consumption theme and your financial services theme, but with a market leadership bias, which means that small and mids, as and when it starts becoming cheap, you'll have more small and mids coming in. But given how currently valuations are, it is more tilted towards the larger names. Okay, larger names is what you should look at. Now, when we look at a thematic idea, for example, let's take consumption, like you said, right? Auto. It's more top down and bottom up, so it has to be a mix of both. And within that active strategy, we have the option to take an active strategy or a passive strategy, which means we can take a sectoral or a global ETF, right? Uh, Second, on active, then naturally direct equity is the most viable option for us. So what do we do then? Now, given how scenarios are currently, a more active strategy is required for both these strategies, both a bottom-up opportunity and top-down opportunity. So here, for example, you have more stocks coming in rather than having more baskets coming in. Now, when the basket starts to look cheap, then you have a passive strategy that can come in more on the ETF part. Now, how have we tried to take advantage of this sort of philosophy? Now, for example, since our inception, we have been very bullish on banking. And at that point, we had a more top-down opportunity in banking, and we wanted to take a more basket approach because the entire pack was extremely cheap, right? Particularly on the public sector side. So we were able to capitalize on that entire basket where our buying strategy has been extremely staggered. Our selling strategy also has been extremely staggered, right? So it takes us about 1.5 years to entirely build up onto our conviction for a particular portfolio. However, when somebody on board with us, it depends on the opportunities that are available to us. So every portfolio that we build is completely different. Today, the opportunities versus the opportunities that were available to us 6 months back are completely different. So somebody who started onto this strategy 6 months back versus today will have a different portfolio, and day one deployment rates would be completely different. So usually it takes us 6 to 8 months to invest in all the opportunities and make sure that your money is put to the best available opportunity that's there for us. 6 to 8 months it would take, but to build onto a conviction for our ideas, There we would scale it up, probably in 1.5 years or so. So we don't have any cap on that as well. We can go more than 5% in a particular theme, in a particular idea, or in a particular stock. Like we can do that as well. So it takes us some time to one, deploy the entire money, and second, to build full conviction into the positions that we're looking to build. So staggered in and staggered out. Similarly, as valuations start to become expensive and then move on to very expensive, naturally it comes off first. This we are able to do across all asset classes that we're looking to invest in: equity, debt, precious metals as well, and global. Right. So the whole idea is to build versatile portfolios that can prosper in all markets. Like whether it is a war, whether it is not a war, the idea is for us to build versatile portfolios that at every market, an investor should say, yes, any time is a good time for me to put money in new, because the strategy is extremely dynamically managed. Right? For example, when you have high inflation and high interest rate, we understand that fixed income tends to outperform. When you have high growth in earnings coming in, and then psychologically there's a re-rating that can take place in terms of the early recovery for a particular cycle to take place, where equity outperforms. But when you have low growth and when you have multiple issues that can come where you need to employ a dynamic strategy in the market, that case, your multi-asset strategy definitely goes to outperform. So now let's look at how we have been able to do very well compared to the entire industry. Now, this is as of 31st May. I think the next number would probably come in a couple of days from now. That is June number. But if you look at May, if you look at how Neo has done compared to your flexi cap category, your multi-asset MF category, your dynamic asset fund category, your one of the largest multi-asset funds, for example, ICICI multi-asset, your Nifty 50 plus our own index, right? If you see from a 3, 6, and 1 year category, we've done extremely well. From since inception also, we have done extremely well. Though we have been there, since 22 as a strategy. This strategy has been already in practice at an advisory level, and now it is coming on to the PMS level. So this strategy has been there since our inception of 2012, 2013. But formally as a PMS strategy, it is in 2022. Right. But more or less, this strategy has done very, very well compared to the existing 100% equity strategy as well. That is available in the market for investors to take advantage of. Now, how do we manage drawdowns? It is a multi-asset category. Drawdowns also have been managed extremely well. So Neo has had a drawdown since inception of -4%. We have not seen this actually cross to a drastic extent, but we are always evaluating to see whether this is crossing or not crossing. Multi-asset category versus that of the Nifty has seen a bad drawdown of 10% and 5%. Drawdown is the worst drawdown, right, since our inception period. Now, what I want you to see is the right hand part. And in that, you see that equity from a fund perspective, right? We might have different levels for every individual investor who comes on board. But from a fund level perspective, the equity exposure is about 78%. We have some debt that is going of about 4.5%, 5%. But this number is increased now drastically. We were at very low numbers. So dynamically, we've been able to manage to add a lot more of debt as an opportunity. We have precious metals to the tune of 12%, and we have some amount of cash of about 5%. This is what I wanted to see, not the returns part. Our objective for the returns part has been average inflation plus 5 to 7%. That is the expectation that you should have. And where do we operate? We operate in between the moderate to conservative risk baskets and risk profiles. Right. This is meant for somebody who is looking to build a retirement corpus in India, right? Who's looking to build a wealth kit in India, where who does not want to see too much of drawdowns, but at the same time wants to make stable inflation plus 5 to 7% sort of return. Okay. In terms of the team, this is our entire team size, and if you see that, that's where we are. So Balji sir, Rohit, Rajat, all of them have tremendous experience in the entire industry. So Shyam sir is a fund manager, and Niranjan sir is a part of the entire Sphere and the Neo team. Right. So Neo and Sphere are one particular basket, which is our multi-asset strategy. Okay. So if you see our rooster is pretty big, right? Now, in terms of the minimum investment, that's about 50 lakhs. We have a fixed fee model. There is no profit sharing model at all. So it's a fixed fee model of 1.5% per annum, which is charged and computed on a daily average portfolio value, which is charged you on a quarterly basis. Okay, so there's no cap again, 0 to 100 in equity, gold, global, ETF, precious metals, anything. So it's a very, very flexible, dynamic approach that we have, where 360-degree investing is the entire philosophy, which means that we will identify and invest in the right asset class at any point in time, no matter what the market is. Okay. I think now I will open the floor for Q&A. Before that, this is a very, very interesting market app that we have. It's on our website. You can just go to ithought.co.in and you can just go on to the blogs. You will see this here about how investors and managers now uh, are actually getting a lot more anxious and they're not thinking about scenarios that are developing right now, and that FOMO is actually picking up right now because the index at the index level indexes have done very well over the last 1 month. That catch up is there. So the hurry is our worry is that's the whole point. So here on all our uh, strategies, we do not deploy everything at one go. Like I said, it's a staggered in approach and a staggered out approach. Even for a 0.5% position for every investor that we want to build, there is a big investment company that debates on how much we need to invest for a particular person. That's how big the team is. That's how strong the processes are, and that's how we're able to control on the risk management. Okay. I think now I'll open the floor for Q&A. Okay, markets eventually do recover, but can there be a scenario where the back testing will not work? See, we don't try to back test at all. So whatever strategy that you're seeing from our side, right? All of this is not back tested. All of this is real the performance that we have delivered to our investors. So we like to see what has happened in the past to study things on how behavior and psychology works. But everything that we're doing here right now, unlike that of a mutual fund when an NFO comes or anything of that sort, comes, you see that there is a lot of back tested data, and then ultimately when AUM is gathered and then investments are being put on, naturally it does not work the way it is expected to work, right? So we are doing it live. There is no back testing that we're doing. These are all tailor-made solutions that we are already doing for investors. Okay, in solitaire PMS, why I thought is avoiding banks and NBFC stock under present circumstances will it lead to underperformance? So for solitaire, it's a flexi cap strategy where the mandate says that you do not have to invest in leverage businesses. So naturally, by that, banks and NBFCs do not come because their business itself is leveraged. But this is an extremely high quality portfolio where the performance also has been extremely good for this particular strategy, and you don't have to worry about missing out. So you have a completely ex bank, ex NBFC sort of a portfolio where you have solid bottom up ideas only coming in into this portfolio. Your underperformance will not be because of probably banks or NBFC, but you usually see this level of underperformance come in when you have to reposition yourself for the next phase of growth. So that is a point where you have to capitalize on, because the next phase would require newer ideas, newer venues. So it would take time to build on to those positions. That's where you might see some change coming in, but understand that these are played out ideas, and then after that we're looking to build on to newer ideas, newer sets of ideas. So your participation level needs to be extremely high. That's what we usually, practice. That's what you usually see. Okay, do any of the product have exposure in large cap? If yes, how much percentage? For us on Neo, our large cap exposure is plus 75%. We have a pure large cap only fund, which is True Blue. So if you see here, you say Balaji GR, who is the head of research and the co-fund manager of True Blue. So True Blue is our 100% large cap only product. It's a high concentrated large cap only product where you will only have like 23 or 25 years creamy player of growth that is in Nifty 50. That's it. That's the universe. Okay, your forecast for IT stocks for the next quarter, please. Slowdown is there. The commentary that is coming in from uh, businesses is that You have a lot of inquiries in terms of order book, but execution might get more delayed because of the whole geopolitical tension that's happening. So that's the only, issue that's there. Slowdown is there because of those reasons. That's the only thing. Might take a couple of quarters for sentiment to change on executing orders. Okay, will rupee remain strong for the next 5 years as dollar is losing its value? See, we have to see these are extremely interesting times because in one way Trump has said that he wants to keep the dollar weak, so more investments and a lot of capacity creation can take place within the US. If that is the case, a lot of money goes into emerging markets. So that is one theory. Second theory is that in the scenario that we're currently in, so that means you need to have alternate currencies, right? So that's why precious metals become and commodities become extremely valuable. Second theory is that maybe because of this war-like scenario, you say that is more pumped up to make the dollar look extremely strong because of overall weakness everywhere. So it's a very tricky scenario for you to look at, but we go with an expectation and assumption that the INR depreciation is might not be as high as what it was in the previous cycles of 3.5%. It might be lower and it might be more prolonged. That's the only thing. We go with a lower estimate for INR depreciation. Okay, what are the challenges do you see for Indian economy? Is rate cuts enough, or are markets ignoring the ground level scenario? See, ground level scenarios show that capacity is reviving slowly. In terms of growth, you might see problem if you don't have a good consumption spent by households now in the next probably this year. You might have a growth problem that can come up. From a balance sheet problem for the RBI and from a macroeconomic fundamental, I don't think you have much issues that are there. But first spur for consumption has to happen. So a lot of benefits have been given, 8 pay commission also coming up. So if that part does not work, then that is a risk. US dollar is weakening share steadily. Any thoughts? That's why we always look to have alternate currencies on the portfolio. That is why multi-asset strategies work. So your precious metal basket becomes much more valuable. Okay, US market is at all-time high. Any view on Trump's recent bill impact on global economy? See, for US, no, I think there's a lot of sentiment that is, inflated on the positive side. So with all these changes that are taking place, I think tax bill also is coming up. So, a lot of positive sentiments that are there. From a valuation standpoint, they remain expensive. So better to just sit on the sidelines and see whenever an opportunity opens up, if at all the opportunity is juicy enough to take. Better to be in the audience. Thanks. We'll keep the floor open for another couple of minutes. If there are more questions, I'm very happy to take it. I'll just keep it open for another couple of minutes. No problem. All right, done. Thank you all so much for joining in. Have a great weekend ahead. Thank you so much.